This is judgment week for the dollar. High impact inflation data incoming. How is the dollar going to react? Ken Chigbo back with an E8 markets fundamental update. Let's jump straight into this video. So the dollar's incoming big movements now are going to be very much dictated by how this inflation data comes out this week. Now, before I share my screen, just want your attention, just speak about the importance of this data. If you look through the back end of 2023, all of that market volatility with the dollar related, even stocks across asset classes, was all being driven by interest rate cut expectations. When is that first cut coming from the FOMC, and how aggressive are they going to be with rate cuts? Now, those rate cuts that are being priced in at the back end of 2023, the early part of this year, have been repriced by markets because they've been further pushed back to later this year. The reason being, one of the key reasons for that and all that volatility was due to inflation in the United States remaining sticky. If inflation remains elevated, right, prices of goods and services are still high. Economics 101, the FOMC, a central bank, has to keep rates higher. Why? They have to keep rates higher because, remember, when we're keeping interest rates higher, it means people's expenses are going to be higher, right? Borrowing costs, their outstanding mortgages, their outstanding loans, their credit card balances, all of that, right, remains high because they're paying higher interest. So these people are going to be less reluctant to want to go out and spend their money, okay? If we're getting less people going out and spending, then eventually the businesses that are offering these goods and services are going to start putting down their prices. So prices will start to come down with that falling in demand. You know, that cooling of aggressive consumer spending. Do you understand that? So this inflation data is very much important because it's going to dictate markets' pricing of interest rate cuts. They now want two. Markets want two cuts, especially after they saw a cooling in the labor market figures. Just those recent numbers from the in the form of the NFP, the jobs being added less in the economy, the unemployment rate ticking higher, the average earnings, what people getting paid coming down. All of that was disinflationary. Let me share my screen. So inflation data kicks off on Tuesday where we get PPI data. Now, PPIs are the producer prices index. Okay, so this is the costs for the producers of the goods that consumers are consuming. This doesn't have as much as an impact as CPI, but this is definitely going to set a tone heading into the key CPI readings, which are the consumer prices. You know, the prices that consumers are paying for their basket of goods, their general living expenses day to day. So we'll keep an eye on these PPIs. Now, when you look across the board with the key, now I'm talking about the key being the CPI, core, right? Core strips out the volatility of food and energy. It's expected to cool to 0.3%. All right, the month-for-month headline expected to remain unchanged at 0.4. The year-on-year expected to cool down to 3.4%. Now, the general expectation for this cooling comes with the falling of gasoline prices. Also, we're starting to see a bit of a slowdown, as I mentioned, disinflationary in the labor market, okay? Signs of the labor market worsening. So if we're getting a worsening in the labor market, you've got to remember as well, what does that mean for inflation? Okay, it means we've got less people in the potential workforce, less people getting paid more, higher unemployment, which means less going out, stimulating the economy and stimulating prices. All right, so keep that in your mind. Now, ahead of all this CPI data, just want you to channel this in a moment. Ahead of this CPI data, when you look from April, right, at everything on an inflationary level, look at ISM manufacturing prices. So the prices for manufacturers remained elevated. Look, 55.8. Okay, when we go further down here, just want to get your attention. Further down, look at CPI. That last month was very much elevated, yeah, higher than expectations. If you look at the, what else I want to mention here? Let's get it up. Retail sales was elevated. That's inflationary. People still spending. Retailers are performing well. Okay. If we go further down here, GDP price index. This is the prices of the goods and services that are used to measure the GDP. That was elevated at 3.1%. Pending home sales higher. Personal income and personal spending higher. This is all inflationary. House price index data as well, inflationary. So I'm mentioning this because heading into this figure, we're expecting things to remain inflationary. Now, that's not to say that is a given that we're going to see higher inflation data coming in on Tuesday and Wednesday. So markets are potentially gearing up for higher inflation, even though these expectations are expecting slightly cooler. Markets in their minds have it could be higher. Now, if that comes in higher, right, obviously we're going to see those dollar balls reignited. We're going to see that those 2 rate cuts that are being priced in at the moment. When you look here in the Fed's CME watch tool, we look at the Fed's CME watch tool to see how markets are pricing in things. Now, obviously, we're not expecting anything in June. There's a low probability of a rate cut. In July, low probability, just 25%. But markets are really expecting now, the general consensus is that we're going to get that rate cut, that first rate cut, that one of 2 in September at 61% chance, okay, probability. November's pretty high at 75% almost. And December is very high probability of 87% chance. But markets, as I say, are expecting 2 rate cuts. And that's why the dollar lost a bit of momentum in the last couple of weeks as markets start to repricing and get, those rate cuts that they want. They want those rate cuts now. Okay, so this data this week is going to be very much driving the dollar's trend and also indices, which I want to touch upon in a moment. So I really want you to focus on this week, guys. Ahead of that, obviously, we've got retail sales data as well. Also in line with those CPI figures, which are expecting to cool as well, down to 0.2% on the core and 0.4% on the month-on-month. Now, if we take a look technically here with the dollar, you can see, as I explained before, we're trending to the upside at the moment, 4 consecutive months. We're seeing a slowdown so far in May as markets, as I say, are starting to reprice in more rate cuts. We're expecting 2 now, as opposed to, a few weeks ago, we're only expecting 1 cut, but now 2, getting more dovish there potentially. If you look here in a weekly, obviously we've been trending to the upside, as I say, for the Dixie, the dollar index, we've been printing higher highs and higher lows, but signs of momentum being lost there. But as I say, this direction is very much going to be dictated now how those CPI figures come out. If it does come out lower, expect heavy selling pressure for this dollar, and the dollar's peers to obviously take advantage of that lower CPI there. When we look at indices, right, to show you this on a naked chart a moment, you can see within recent weeks, with the dollar slowing down, stocks rallying because they're expecting those rate cuts. Remember, if we get rate cuts, that's bullish for stocks. So stocks trending to the upside at the moment as well. US 30, NASDAQ, SPX, all pushing to the north in anticipation of more rate cuts in the dovish FOMC. So if those numbers do cool, we see inflation cooling, you're going to expect stocks to go on and print record highs there. GBP is back in the spotlight after last week's Bank of England rate decision, where surprisingly it was dovish. We had 2 members calling for a rate cut, right? In comparison to the last decision where all 9 members were unanimous in wanting to keep rates unchanged, higher for longer. But we're getting closer now, given that we've had 2 dissenters there calling for a rate cut now, we're getting closer towards, potentially dovish Bank of England. When you look at the statement, it was dovish. They're seeing rate cuts coming. They're seeing lower inflation forecasts. If we're seeing inflation lower, it means we're getting closer towards rate cuts. Remember, because we only start lowering rates when we've seen lower inflation for an economy. Okay, so this is very important now. And as I mentioned before, why GP is in the spotlight this week is because we've got labor market data. And as I said, with the dollar, labor market plays a massive factor in influencing inflation trends. Okay, if we've got a decent labor force, right, i.e. low unemployment, wages are high, less unemployment claims, it means obviously we've got a healthy labor market, people out spending money, stimulating the economy, and obviously keeping inflation higher. But if that starts to worsen, that's disinflationary. So let me just take a look here. Look, on Tuesday, we've got the claimant count change. We're expecting a worsening in claimant counts, more unemployment claims, going up to 13.9 thousand. The average earnings, this is really key here, guys, is expected to cool down to 5.3%. Okay, the unemployment rate is expected to tick higher as well to 4.3%. Now, this could really go hand in hand as a double whammy for GBP on the back of obviously the Bank of England, where they're getting closer toward dovish, but that will reinforce that dovish view from the Bank of England, because obviously if people are getting paid less, if there's higher unemployment claims, higher unemployment rate, that's disinflationary. Less people out, as I say, in the workforce outspend and stimulate the economy. So this is certainly going to dictate GBP. Now, when we look specifically at GU on a monthly, obviously we're to the downside at the moment. 1, 2, 3, 4 consecutive months, obviously on the flip side to that upside in the Dixie. But it does still look vulnerable when you look at GP versus the dollar. We have to remember a lot of these moves that are coming, right? For currencies, in terms of a currency having an edge over another, will come with economic growing monetary and economic policy divergence, right? Economic and monetary policy divergence, i.e. one central bank has higher rates, the other one has lower. You know, one's cutting faster, the other isn't. That will create that divergence, and that will create an edge for one currency versus the other. So we could very much see that with GBP versus the dollar, right? In the latest week, we managed to finish almost flat, okay, minor negative, but we still remain vulnerable. Now, GU may be a tricky one to trade this week because of obviously the inflation data for the United States. That's why you pick your pairs wisely. Maybe seek, alternative currencies versus the pound, right? And look for that growing incoming monetary policy divergence. Other central banks may keep rates higher for longer in comparison to the UK, right? It's not just the FOMC, okay? Look at other central banks, maybe the RBA, maybe the Bank of RBNZ. You know, go and do that analysis. Those divergences are out there to be capitalized on, guys. I'm being serious, right? So here, with GU at the moment still, we're still very much structured to the downside, okay? You can see it really clearly on a daily at the moment, still printing those lower highs, lower lows, lower high, lower low, lower high, potentially a new lower low. It depends on obviously this data that we're going to have this week from obviously both the UK and both the United States. But when you look here in the monthly, it does scream potential vulnerabilities, but we could, the technicals here are very much going to be driven by these incoming fundamentals this week. Australian dollar is also back in the spotlight after the RBA decision, where the tone was generally neutral, okay? They could hike rates, they could cut rates, they say in a nutshell in terms of their tone. Now, why this is back in focus is because look, it's labor market data central this week. We've got wages price index from Australia, where we're expecting wages to pick up actually to 1% from the previous of 0.9. The employment change, we're expecting a decent amount of jobs being re-added to the economy of over 25,000, but the unemployment rate is expected to tick higher at 3.9%. Guys, you know the importance of this now, as I've just gone over it for the UK. I've touched upon it for the US as well, where if this data does come out higher and better, we get higher wages, higher employment change and lower unemployment rate, that's going to sway the RBA's decision, right? And they will need to keep rates higher for longer, because that will be inflationary potentially if that does come out higher. But obviously on the flip side, if it's lower, you know what Aussie dollar's going to do. Aussie dollar's going to sell off in anticipation of those incoming rate cuts from the RBA. Now, there is so much volatility around Japanese yen. I'm sure you guys would have seen a lot of weakness for the yen because, historically, Japan have had negative rates, low rates, right? Where people can borrow money in Japan. People in Japan, they borrow money for cheap because they don't have to pay interest, right? Rates are low. And then what do you think they go and do? They go invest that money that they've just borrowed for cheap. They go invest in higher yielding economies such as the US, the UK, Australia, Canada, wherever another central bank or other economies are offering higher rates, they'll go and invest there. So outflows from Japan, so weakness in yen because they have to sell their yen and then they go and buy dollars or they go and buy GP, right? So there'll be strength in that currency. That's the carry trade. You guys can go and do some back testing and some research on that and see how profitable that carry trade can be, simply from that huge divergence. Now, obviously, Japanese officials have been trying to step in to counter that yen weakness and intervene in the currency markets, but it's not helping, and yen still remains vulnerable. Now, if you take a look at my screen here, this week we've got GDP data from Japan, and this is one of the reasons why they're reluctant to want to raise rates. That's something that they could do to try and prop up the yen, okay, to stop people from taking money out of Japan and going and investing elsewhere. They could raise rates, but the economy remains fragile. Look at GDP here. We're expecting quite a chunk. We basically have a technical recession here for Japan, and we're expecting another contraction, a huge one, growing to minus 0.4%, okay? Contraction 0.4%. So they can't rush to raise rates if the economy's in recession, because remember, we're going to impact people's affordability by raising their costs. So expected a contraction there on GDP. Obviously, if that comes out lower, expect yen to get smashed. Yen still remains vulnerable. When you look here on a monthly, despite the interventions, look at those big bullish candlesticks here for UJ. We left this wick, which could very well be filled, and that could go hand in hand. That could be supported by those fundamentals. If this GDP does cool, look at GJ, same sort of thing. We've left that wick, big bullish candlestick. Same there with EJ. You can see the markets just want to continue to test these Japanese officials until something drastic happens. Okay, so yeah, yen potentially remains vulnerable there depending on this GDP figure. Very lastly, in Asia, we'll keep an eye on Chinese data. It's important that we focus on China as well, because there have been on and off concerns about a Chinese economic slowdown. Remember, they are the second largest economy in the world. And if we see a massive slowdown in China, that could have a ripple effect across the world, really across other major economies, because everyone's so interconnected with China. China are a huge manufacturing hub for a lot of other major economies. And remember as well, China is Australia and New Zealand's biggest two-way trading partner. So anything positive or negative is also having an impact on Australia and New Zealand. So if you look here, we'll keep an eye on industrial production for the economy. It's expected to pick up the 5.4%. Retail sales expected decent number of 3.9%. So if this data does come out higher, it will largely reduce concerns about a Chinese economic slowdown, and that could be very much supportive of AUD and NZD upside, but so long as it does come in higher. Obviously, on the flip side, if we get a weaker number, then of course that's going to be a negative for Australia and New Zealand. All right, guys, that's it from me. Have a blessed trading week, and I look forward to seeing you on the next video.